Morning, everyone. Thank you for joining us. We've still got some participants getting logged in, so we'll give it a minute or two, and Scott will kick us off here in a moment.
For those of you that just joined, we're still waiting for some additional participants. We'll give it about 30 seconds and we'll get going here. And Brett, you can let us know when we're good to go.
Yeah, it looks like things are starting to slow down. I think we're ready to kick off here.
All right. Well, thank you, Brett, and welcome everyone to our webinar entitled Turmoil in the Banking Sector, Silicon Valley Bank Analysis and Implications. I'm Scott Duba, Chief Investment Officer here at Prime Capital Investment Advisors. I'm joined by three of my esteemed colleagues, Brett Newell, who's in our Overland Park office.
I think we lost your audio for a moment there.
Can you hear me now? Can you hear me?
Yeah.
Okay. I'm joined by Brett Newell, who's our private investments analyst in Overland Park, Clayton Allison, who is our custom portfolio manager, also in Overland Park, and Vineet Madden, who is in our California office, who is a portfolio manager on some of our core portfolios and our total stock portfolio. We've got a lot to cover today, so we'll dive right into it. Brett, if you wouldn't mind walking us to the first page. So just to set the stage here, we're all inundated with a lot of concerning headlines over the past week. Silicon Valley Bank, its failure and concerns about the health of the financial system have been dominating headlines really for the past 7 days. We've had the first major bank failures in over a decade, really since the Great Financial Crisis. We're seeing some spillover into regional bank securities, even into some European banking sector names that are under pressure. And we're having government intervention, which reminds everyone of the Great Financial Crisis. So in order to hopefully provide some clarity, some explanation, and some calm amidst these concerning headlines, we're going to run through a series of questions that we'll try to answer. We're going to talk about what happened at Silicon Valley Bank, what actions the Fed took, what this means for the banking sector. We're going to talk about what all of it means for the Fed's fight against inflation, implications for the economy and the markets. And then we'll talk a little bit about bank deposits, how FDIC insurance works, and what other options there might be for bank deposits, especially in lieu of the very large spread between what banks pay on deposits and what one can earn in the Treasury market. So with that, let's dive into our first slide here. So just for reference, let's just remind ourselves how banks make money. I think this will be an important tool for us to understand kind of what's happening with Silicon Valley Bank and with the financial sector as a whole. So in short, banks borrow cash cheaply from depositors and they lend it out at more expensive rates. That's what bankers do in a nutshell, and that's how they make their money. If you look at the left side of the page, this is how banks get cash. It's from liabilities and equity. The preponderance of those liabilities are deposits from customers. That's you and me and everybody we know keeps some amount of cash at a bank, typically at a very, very low interest rate. They also get capital from debt investors and equity investors, both of which are more expensive costs of capital, but most of it comes from depositors. On the right side, we have what the bank does with the cash. They keep a little bit in cash liquidity, both in currency and just liquid cash to redeem deposits and make investments and function. They keep a big chunk in sellable securities, which you'll also hear referred to as available for sale securities. They keep a chunk in less sellable securities, which we'll call hold to maturity securities. and then they lend it out in loans. Securities refers to when the banks use cash to buy typically government-backed securities, whether it be U.S. Treasuries or mortgage-backed securities, typically low risk, very high quality assets when they can't lend out enough in loans. If you kind of combine these two things in the middle of this page, this is how the bank makes profit or losses on the cash they put to work. You get interest on your assets, you get gains on assets, and then you have losses on assets. That's kind of the delta in terms of the asset side of the book. Your costs are a function of the interest you pay to your depositors, the cost of your debt, and the cost of running the bank. The net of all this is the profit or loss for the equity investors. So let's keep this in mind as we dive into what's happening with Silicon Valley Bank. If we go to our next slide, let's also keep in mind the major background story of the past year for the financial sector. It's inflation and interest rates. The Fed's been raising rates for the past 12 months to slow growth and tame inflation. This has been a major change in the operating environment for banks relative to really the preceding 15 years. If you look at from 2008 to 2016, the Fed funds rate was more or less at zero, and inflation was pretty tame. Inflation is the black line, and the bluish part is the Fed funds rate. The black line's inflation. It was pretty low and tame for the better part of a decade, kind of bounced between 1% and 2%. And the Fed funds rate was pretty low, from 0 to 2%. As we all know, coming out of the monetary tsunami of COVID, inflation shot up a lot. PCE, the Fed's preferred measure, got up north of 5%, and the Fed in turn had to start raising interest rates aggressively. And this has very much changed the dynamic for banks and how they make money. Next slide, please. If you think about how this impacts banks, remember our model. On the left side, you have the depositors, debt from investors and equity from investors. On the right side, you got your cash, your securities, and your loans. As interest rates go up for depositors, the bank has to pay more interest on deposits, or else those deposits will leave and go somewhere where they can earn a higher return. Therefore, that means a higher cost of deposits for the banks. In addition, if the bank has to refinance debt, it has higher costs on its debt. On the right side of the page, remember how bond math works. If a bond is issued with a low coupon, and then a few years later, bonds are being issued with higher coupons, then those old bonds are less attractive. And the price on those bonds, in terms of how they trade in the market, has to go down so that they're equivalently attractive as the new bonds. So what's happened as the interest rates have gone up, the market price of older securities with low interest rates decline. And for example, if a new bond pays 4% a year and an old bond pays 1%, that old 1% bond is obviously less attractive, and those securities get marked down if you try to trade them. And that would mean losses on assets. Remember kind of how our banks make money model. If there's losses on assets, that impacts the bank's profit and loss. So now that we kind of have the basics of how banks work and interest rates rising, let's flip to the next slide. So this is, now we're going to get into what happened to Silicon Valley Bank. Vineet, who's our portfolio manager on the total stock portfolio, is going to walk us through a short story on what happened to Silicon Valley Bank. So Vineet, why don't you take us through this slide? Give us a little bit of the history on how, maybe what Silicon Valley Bank is and how they grew so fast.
Sure. Thanks, Scott, and good morning, everyone. Silicon Valley Bank was a 40-year-old bank, roughly the 16th or 17th largest bank in the United States, obviously based in Silicon Valley. They were a huge beneficiary of the tech and VC boom, with deposits going from $62 billion in March 2020 to $124 billion in March 2021. So roughly 100% growth. Comparably, JP Morgan deposits grew 24% at that time period. Deposits would peak roughly at $189 billion. Now, the problem number one with Silicon Valley Bank is that they assumed that deposits would continue to grow at the exorbitant pace that it had previously. However, as VC money began to drive up and tech companies, unprofitable tech companies, began to draw upon their cash reserves, the deposit base began to slow. Secondly, if you see a look at this chart, the majority of the deposits were uninsured deposits above the FDIC limit, which Brett is going to go in a little more detail later on. It's a $250,000 limit. So most of these deposits were uninsured, as you illustrated by the red line versus insured deposits, which is the yellow bar. Next slide. Thanks. So Silicon Valley compounded that problem by having a duration mismatch. What I mean by that is they were invested in, their deposits were all short-term, and they decided to take that money and invest in long-term assets. And Silicon Valley made the incorrect assumption that rates would remain low. So in summer of 2001, they began to pile into long-term bonds with rates roughly at 1.5%. With the assumption, like I mentioned, that rates would continue to remain low. And as Scott had discussed earlier, as rates began to rise, the value of these holdings began to decrease. And what happened was, as the portfolio rates began to rise, the portfolio began to decrease, which began to impact their equity base. And as this illustrates, this chart illustrates, the Silicon Valley comprehensive income rolling on a quarterly basis began to decrease because their bond holdings began to decrease as the Fed began to raise rates and interest rates began to rise.
And Vineet, just for scale, if you go back to that one, Brett. So what this is telling us is that through 2020, they were making profits off of this line item to the tune of $500 million. And then it looks like those losses accelerated quite a bit. What was the maximum losses they were getting on these? This is the quarterly figure?
The cumulative loss, I think the more important thing is to focus on the cumulative loss, which was 15 billion versus a 100 billion or 91 to 100 billion equity portfolio. But more importantly, the 15 billion compared to a 16 billion equity base. So the comprehensive losses wiped out their equity bases. So basically you had a bank with no equity in it.
Got it. Okay, thank you. Okay, so now we kind of know the short story of Silicon Valley Bank up to a week ago. So what happened from there is depositors started to understandably worry about the firm's financial health. And remember Vineet's point, these depositors were frequently venture capital and tech companies. And if you're familiar with how venture capital and tech, really venture capital companies work, the cash is the lifeblood of the firm. A VC company is typically not cash flow positive, and they perpetually have to raise new cash every 12 months. So once a VC firm is out of cash, they're effectively out of business, unlike another normal operating business that produces cash each month. So not only was Silicon Valley Bank's depositor base very large and mostly uninsured, but it was a depositor base that was very, very, very focused on their cash and keeping it safe. So what happened was, as these depositors started to worry about the firm's financial health, the bank ran out of liquidity and the FDIC had to intervene. For those of you familiar with the famous movie It's a Wonderful Life, this really kind of epitomized the bank run. If we kind of recap what happened, the unrealized losses versus the equity reached 15 billion, nearly as much as the bank had in total equity value, and the depositor exits accelerated. The next thing, these outflows, in an effort for the management team to raise cash to meet those depositor outflows, they sold more than 20 billion of their securities. Remember that bucket on our bank model that was the easy to sell securities? Well, they had to sell those at a loss of nearly 2 billion to Goldman Sachs. In order to plug that gap, they tried to raise some equity. They tried to raise 2 billion of new equity, again through Goldman, to shore up the balance sheet. However, they had really terrible timing. Silvergate, another bank that recently closed, well, it wasn't taken over by the FDIC, but it closed because its business couldn't sustain. That happened a week ago. So the banking investor community was already quite nervous when SVB disclosed this big loss, sold this chunk of assets to Goldman, and then tried to raise equity. And so the long and short of it is, you had this classic run, just like the scene in It's a Wonderful Life, when Jimmy Stewart is trying to appease the building and loan investors. SVB was less successful than Mr. Stewart. The depositors withdrew $42 billion in a single day. So almost more than a quarter of the total depositor base fled in a single day. That's 42 with a B, as in billion. And that left the bank with negative $1 billion of cash at the close of Thursday, March 9th, in which case the FDIC came in and closed the bank. Next slide, please. So, important question at this stage, how much of SVB's deposits were not protected from losses by the FDIC? As Vineet alluded to, a lot of them, almost all of them, more than 80% of Silicon Valley Bank's balances were not insured. And normally, clients do not have access to funds after a bank failure if they're not FDIC insured. In typical fashion, when an FDIC takes over a bank, closes the bank, their guarantee covers deposits in accounts up to $250,000. So even if Silicon Valley Bank had been closed on Friday, you could go in there on Monday in the reopened branch that the FDIC was running and get all your $250K out. If you had $1 million in that account, that $750 would not have been insured, so you wouldn't have had access to that. If you look at this slide on the bottom from JP Morgan, this is uninsured share of customer deposits relative to various other banks. Silicon Valley Bank was nearly the highest ratio of uninsured deposits. So they were kind of a high flight risk all along, and that made them a very kind of shifty base that was really kind of prone or at risk of a run. If we go to the next slide, Brett. So what action did the government take? Well, much like Miss Bailey, they stepped in with a bunch of cash. To minimize the risk of contagion, the Fed, the FDIC, and the Treasury acted very aggressively. The first thing to note is that there was evidence of kind of this spreading contagion already by Sunday, March 12th. Signature Bank, which actually showed up on the page before as well, they failed on Sunday. And the Fed on Sunday was also observing via their data growing depositor flight from regional banks. So they were already seeing risk of contagion over the weekend. To combat that, they took a very important step that is in their arsenal following the Dodd-Frank reforms. They classified Silicon Valley Bank as a systematically important institution. That gave them a lot more latitude in structuring a more aggressive federal response. If a bank is not systematic, it fails, the FDIC does its thing, and there's really no special treatment. But for a bank that has $200 billion of assets that fails, that's systematic, and the Fed clarified it as such, so they had more latitude. With it then classified as systematic, they took the step to protect all the depositors. Remember, nearly 90% were uninsured, but the regulators decided the best way to stem the contagion risk was to extend that FDIC coverage to all depositors. What this did in a practical sense is that it averted cash crunches and business failures in Silicon Valley Bank's client base. You can imagine the amount of lobbying that the federal regulators were getting from Silicon Valley Bank's customers over the weekend. A lot of these tech companies were set to make payroll this week. And if they did not have access to 90% of their money, their businesses would have failed. So the Fed decided to protect all the depositors in this case. So even if you had 2, 3, 4, 5 million on deposit at Silicon Valley Bank, it's now available. The second thing that the Fed did is they wanted to ease regional bank pressure. The regulators also created the Bank Term Funding Program. What this does is it allows banks to borrow from the Fed against the collateral, which is the face of those securities that are on the bank's assets. Remember the right side of our sheet? You had all those securities. A lot of those the banks bought when rates were 1%, 2%. Maybe they're trading at 80 or 85 cents on the dollar. The Fed said, hey, if you bring those to us, we'll lend against them as if they're worth 100 because they're U.S. Treasury notes. So what this does is it kind of eases the liquidity strain on the banks, so that if they need to tap that asset base for liquidity, they don't need to be a forced seller in the market. they can just go to the Fed and borrow against it. Okay, if we go to the next page, Brett. So let's recap with our bank model, what happened at Silicon Valley Bank. Let's go with our little red fonts here. Number one, on the bottom right, they had these mark-to-market losses. Number two, they had these forced sales to raise cash from their sellable securities. Move over to the left, number three, they had a huge outflow of deposits because over 80% was uninsured. Back to the right side, number four, they ran out of cash. And back to the left side on the bottom, number five, the equity gets wiped out and the debt's impaired. To summarize, rates went up, the value of securities went down, management tried to raise equity, and the depositors ran. So again, a classical bank run story. All right, next slide, please, Brett. Okay, now, important question, why did the government act? Why did they feel it necessary to classify Silicon Valley Bank a systematic risk? Well, the banking sector is basically the circulatory system of the entire economy. All money more or less flows through the banking system. So the number one thing that the Fed tries to do is to ensure the safety and the security of the banking system. So they have to take drastic actions whenever there's any threat to the banking system, because that's an implicit threat against the entire economy. And even with those aggressive actions that they took, which we would argue probably induce more moral hazard, which is kind of the case in the past 20 years, even with those actions, the regional banks are still down 50 or 20% this week. So I think while that doesn't tell us what it would have been had they not taken that action, even with those drastic actions, regional banks have performed the worst they've done really since COVID in the past week. So they acted to avert a crisis. Next slide, please. All right, so now let me flip it back over to Vineet. Vineet, we've walked through kind of some basics on kind of how banks worked. We've talked about how rising interest rates impact bank profitability. Then we've kind of dug into Silicon Valley Bank and what happened there. Translate for us what this means for the broader banking sector, please.
Okay, bottom line, Silicon Valley Bank and Signature Bank were two of the worst culprits, but they weren't the only culprits. Because of the way banks operate, banks are cumulatively holding roughly $600 billion in unrealized losses, and that's based upon FDIC estimates. So long-term impact, banking profitability, number one, is going to get more challenging. Banks are going to have to offer higher rates to maintain their loan deposit base, which is their capital, because of higher yielding alternatives. We'll dwell on that Secondly, you're more likely to see deposit migration from smaller regional banks to larger, too big to fail money center banks. And there was a headline on Tuesday that Bank of America had seen 15 billion in deposits in one day because people and companies are taking their money out of these smaller banks, worried about their money taken out of these, quote, too big to fail banks. And you're likely to see increased liquidity and capital regulations coming back to the industry. If you see on the bottom left right there, you're seeing that bank deposits are being drawn down because there are other higher yielding alternatives such as treasuries and money markets. I know that we'll be talking about that later on. Secondly, on the bottom right, you'll see the difference between bank deposit rates and money market funds. Clearly, there's a huge spread there, roughly 4% versus 0.5%. So bottom line, the banking industry is going to look different and more challenging, particularly for the smaller regional banks going forward. Back to you, Scott.
Thank you. Okay, so this is a headwind for the banking sector, but let's flip it over to Clayton Allison. Clayton, what does this mean for interest rates in the Fed's inflation fight? You spent a lot of time on our team monitoring macro conditions, listening to Fed speak, and seeing kind of how the market is guessing where the Fed funds rate is going to end up. What are you seeing in terms of reactions to all this in interest rates and kind of inflation, Fed fighting expectations?
Sure. And yeah, thanks, Scott. Thanks, Denise, for all the information. Largely what we think that this is going to do for the Fed's inflation fight is honestly it complicates matters. With the banking sector stability kind of in question over the past week or so, we've seen a vast array of different bets going on in the futures rates market as to whether the Fed's going to hike in March or they're going to pause completely to give some time to re-strengthen, stabilize that banking sector. Now, that doesn't mean the fight for inflation is over. I mean, we saw that in February with CPI numbers still increasing month over month. So they can't just put it to the back burner for this one-off event that's going on right now. It's still very much on the forefront of their mind. It's just a matter of, whether or not they go ahead with the projected 25 basis point hike, or if they go ahead and pause. Now we are starting to see some moderation in the services sector. I think we saw that services less rents actually only increased by 10 basis points this past month, which is probably its lowest increase in well over 6 months, if not a year. And we can see some of that primary rent residence inflation figures start to roll over a little bit, as we can see in the bottom left-hand chart there. But largely to say, even if they pause this month, the fight is not over, and they're still expected to be pricing in additional rate hikes come the following meetings in May and June. It's just a pace as to what peak rate we're looking at that point. So really, it's just murky waters at this point, and we keep monitoring those futures probabilities day over day.
So Clayton, remind me kind of what the expectations are for this upcoming meeting. I feel like 8 weeks ago or 2 months ago, when we looked at it, the expectation was no hike. And then the inflation readings came out very aggressively, and I thought that we were expecting 50 basis points of hikes. And then where is it kind of shaken out so far? What's the market telling us in terms of what the expectation is for next week?
Yeah, so you're definitely right about that. I think even in January, most futures were starting to price in maybe one additional hike in January. But then really after those January numbers came in, all of a sudden every figure changed, especially when that jobs number came in. It was pricing in an additional 50 basis points actually in this upcoming March meeting, even just 2 weeks ago. And then everything cascaded with SVB. And now it's whipsawing every single day. So yesterday they were pricing in a pause. That was the primary probability at that point. And now I just looked this morning, there's about a 75% chance that there's going to be a 25 basis point hike. So unfortunately, any chart that we put in here right now showing you everybody the probabilities is probably going to be out of date within the next hour. So as much as I would love to be able to give you a live feed, I unfortunately cannot.
We won't hold it against you. Thank you, Clayton.
Yep.
All right, so maybe zoom out a little bit. We've talked about the Fed, the banking sector. Clayton, what does this mean more generally for the economy?
Sure. So, I mean, if we just boil it down and summarize it pretty easily, we keep seeing lending rates go higher and higher. And as the stability of the banking sector kind of gets called into question, there's going to be calls for tightening up those lending standards. So then in that regard, there's going to be less loan activity, which then in turn is going to just cascade into lower business activity as various investors or businesses opt out for investment opportunities because they don't want to pay that higher cost of financing. So what that leads to is then lower growth for the overall economy, because most people don't want to be taking out a loan at 7.75%, for instance. So what we're probably going to see is reduced loan activity and tighter lending standards going forward.
So tighter lending standards from the banking sector, and this chart, I think, if I'm interpreting correctly, the top is the dashed line is commercial bankers' proclivity to lend or confidence, something of that nature, correct? And the dark line is the rates.
Yes. So the top chart, just for everybody's reference, that dotted line is the bank's willingness to lend out consumer installment loans, while the bottom solid line is just the prime lending rate right now. So that's at about 7.75%. And as you can see, as those lending rates go higher and higher, the propensity to lend goes lower and lower. So there's an inverse relationship there. And as you can see, the bottom chart is actually quarter over quarter GDP growth. So Lower loan activity, higher lending standards is going to then probably lead to lower economic growth quarter over quarter.
And the shaded bars, those are past recessions, correct?
They are.
Okay. And so typically what we see is the bank's proclivity to lend declines as the prime rate goes up ahead of a slowdown or a recession. And typically that manifests itself into a slowdown, if not of an outright recession.
Yes, and I mean, there is maybe a green offshoot from this as we are getting closer and closer to the Fed's hiking cycle being over, and even there's being priced in potential cuts towards the end of the year. So there might be some ability to buffer that headwind, but right now you totally got it right on the head.
Thank you. Okay, so now let's talk about what this means for the market. And I think, you know, when you're talking about implications for the market, a bit of context and humility is necessary. You know, whenever we have these rather large events, it's hard to draw definitive conclusions. But our general thinking is that it's negative for growth and for risk asset pricing, at least for the medium term. The main question is this a canary in the coal mine or not? Whenever you have these cracks emerge in the financial sector, it typically signals other things below the surface that you're not seeing. And this is probably the second or third thing we've seen in the past 12 months that would signal just the stress that higher rates are having on the financial sector. One example would have been the gilts move in the UK a year ago. You know, we've seen other various minor blow-ups, but this is, you know, it's an indication of stress in the system. It's too early for us to tell how much exact financial sector pain is yet to come, but I think based on what Vinny's told you about bank profitability and what he sees, it would seem that it's going to be somewhat material. And just for context, the Fed typically tightens until things start to break, and that's kind of been what people have been waiting for. Is the Fed's on this tightening path? They're trying to slow growth and engineer a soft landing, but that's hard to do. Our economy's been used to low rates for 10 plus years, and so obviously, if you're trying to make an omelet, you're going to break a few eggs. And just for context, Ben Bernanke in May 2007 said in his congressional testimony, the subprime mortgage crisis is likely to be contained. That obviously proved not to be the case. So we just offer that up as, you know, we don't have an exact crystal ball, but banking sector pain is generally not good for growth. Second point is the importance of confidence. The banking system and the economy in general are built on confidence. When people are optimistic, they lend, they borrow, they build, they hire. While this episode is seemingly contained, you'd think that these animal spirits are probably going to be tempered for now. Third point is just credit versus rates. Interest rates are risk-free rates, generally, in terms of how we've been talking about them. Credit is the availability of credit and the cost of credit. So it's the bank's proclivity to lend, and it's what you have to pay over the risk-free rate to borrow. And while we've seen bonds rallied over the past week, which kind of lowers overall borrowing costs, we think that credit becomes a bit constrained coming out of this, and credit spreads are probably going to move a bit wider. If you look at the graph on the right, the light blue shaded region is the S&P 500 that kind of went from, call it 3,850 to start the year up to about 4,200, now back to a similar zip code now. The dark blue line is the U.S. Treasury rate, the 10-year. It kind of started the year at 3.5, went up to about 4, and is now back down to 3.5. So this lower credit, lower interest rate, it lowers overall borrowing costs, but this credit's still going to be hard to come by. Fourth point is just recession risk. Obviously, lower business confidence, less credit creation, and lower growth increase the odds of recession. That's kind of a no-brainer. We don't know when, we don't know how severe, but we would think this is a more dampening effect on growth going forward. And last point is just kind of a little bit of insight into how we position things. You know, we remain relatively defensive in our positioning across our portfolios, and in particular, in our total stock portfolio that Vineet does a great job managing. We've been underweight banks year to date, really on concern about bank profitability. And the only ones we own are JP Morgan and Bank of America, which we think as large, major money center banks will be net beneficiaries longer term from the deposit flows and the tighter regulations And I think Vineet gave you a kind of a case in point of that, of how B of A gained 15B in deposits in one day. Brett, if we go to the next slide, a big question we've gotten from some of our clients is just around the basics of, is money at a bank safe? Brett, you've dug into, you've kind of refreshed on FDIC insurance. Why don't you walk us through kind of typically how this works?
Yeah, thank you, Scott. So the short answer to is money at a bank safe is it depends. Mostly on what you're holding and how you're holding. So on the table on the left there, we can see that savings, checking accounts, money markets, etc., are covered by FDIC insurance up to that 250,000 maximum. Things that are not covered by the FDIC are other types of investments, stocks, bonds, including municipal bonds, life insurance, annuities, etc. So that's one aspect to keep in mind. And then another really important particular FDIC insurance is how is that being held? It's by the legal entity of the account. And so there's an example there on the table on the right where a single individual has multiple accounts, and all total, they're coming up to 260,000. Even though that there are multiple accounts, it's the same person that is the legal entity owner for those accounts, and so they are actually above the insured amount and thus have $10,000 uninsured. So if you have any questions on, is my money safe at the bank that you're with, we highly encourage you to reach out to that institution and just simply ask them. They should be able to walk you through how all that is organized, and at times some banks may even purchase some additional insurance beyond FDIC. So again, best way to mitigate and answer that question is to reach out to your bank yourself.
Okay, thank you, Brett. And obviously, you can, if your bank is less responsive, obviously call us, call your advisor. We're happy to help you as well. Okay, next slide, please. Another question we've gotten is just around Charles Schwab. Their equity price has traded down in the past week. They're a big counterparty of ours, a big important strategic partner of ours, where we custody a lot of our assets. So we thought it would be a good time to kind of address any potential concerns or questions around Schwab. One key point is that our client assets at Schwab are not commingled. When assets are custodied at Schwab, that's through their broker-dealer. It's not through their bank. So 401k assets, brokerage account assets, these are all held in the client's name, separate from everything else. And 401k assets are not lent out. It's a straight up custody relationship with the broker-dealer, not the bank. Second point is the bank affiliates at Schwab that participate in the bank sweep program for some of the cash in your brokerage account are very conservatively managed. If you look at this table below, this is a bar chart that shows the percentage of deposits that are FDIC insured at various banks. This is from Goldman Sachs. We put a red box around Schwab because you can see it's one of the most conservative ones on the page. Over 80% of all deposits at Schwab are insured. And that's just on the FDIC insurance side. All their other metrics are very conservative. Their loan to asset ratio, the cash flow of the firm, the liquidity levers they can pull. Their chairman, their co-chairman, their CEO have put out some very good information over the past week publicly, and we've been in material and regular private conversations with our contacts there to get full comfort that Schwab remains extremely well capitalized and really kind of a different animal than some of these regional banks that are on the bottom right part of this table. And last point to make is that what Schwab does also with our clients' money is they have two different affiliate banks. And so if you did have 500K in your sweep account, it would be split between two different banks. So you'd be fully FDIC insured for both of them because your 500K would be split at 250K each. So Schwab is a very, very solid institution that we remain very comfortable with as a counterparty. If we go to the next page, let's flip it back over to Clayton. Clayton, talk to us about rates. I think hopefully we've made the point that if you're at a really good, well-capitalized bank, your money is safe. But is it a good idea to have a lot of cash at a bank? Is it the best thing I can do with my cash relative to what you're seeing in the treasury and money market world?
Sure. Thanks for flipping it back over. And I think it's a good caveat based off of what Brett mentioned earlier in his breakdown, where you have CDs and money market funds that are all FDIC insured. Now, I love my bank. Quick shout out to USAA, but I don't think I'm getting a whole lot off of my savings account in there. As you can see, I didn't put them in here, but you can see to the chart on the left, the average savings interest rate that most people are getting from just keeping their cash in a high yield savings account is very, very minimal. And that's across all the best well-capitalized banks, JP Morgan, Bank of America, Wells Fargo, Schwab, for instance. What we are seeing is there are better avenues that you could be using to really capitalize on that cash sitting in your accounts, whether it be money market vehicles, treasuries, CDs, very cash-like securities. And as you can see in the table on the right, you could be getting 4 to 5% in yield rather than the 0.01% that you might be getting from just holding it in a high yield savings account. But that's something that you could definitely be talking to your advisor about, and they can kind of direct you on which avenues might be best for you to use in your particular situation.
So just to be clear, JP Morgan and Bank of America pay 1/100th of a percent, and that is FDIC insured, which is the federal government, whereas you could buy a 1-year federal government T-bill at north of 4%.
That is correct. And it looks like Goldman Sachs might be the outlier in that table, but as Brett and I were discussing the other day, we're pretty sure that there's a minimum on that account value. I can't just walk into Goldman Sachs and open a $100 savings account and get 3.75%.
Okay, well, let's flip to the next one, Brett. So let's dig into this a little bit because we think it's an important point to make. If we go back to our bank model, the spread between money markets and deposit rates is as wide as it's been in a very long time. And that means that there's a lot of excess spread that banks are able to earn by people who leave excess cash in their bank account. Now, obviously, we all love our banks for normal day-to-day expenses and working capital. But to the extent you have excess cash at your bank, there's really a very high opportunity cost on that cash. If we look at our bank model here, on the left in red, deposits from customers, think of that as excess cash. Look in the middle, the bank's paying you 0.1% or really 0.01% on the excess cash. What they do is then they invest that into sellable securities on the right, which is risk-free rates, U.S. Treasuries, basically risk-free things that have the same risk as an FDIC insured guarantee, maybe with only slightly different liquidity provisions. The bank gets north of 3% on that. So they earn about 300 basis points or more on your excess cash, and that all goes as profit to the bank. If we flip to the next slide, we would encourage people to think about cutting out the middleman in this regard. If you have excess personal or corporate cash at banks, our advisors would be happy to assist you earning higher yields directly in any of these very low risk, very high liquidity U.S. Treasury type funds and money market funds that we have available on our platform. You can move your excess cash to risk-free U.S. Treasuries and reclaim the spread. That's good for you. It's bad for the bank because they lose the profitability because they lose the spread. So if you take one thing away from this, your money is safe at a bank, but there's a high opportunity cost today of just leaving it there. And our advisors will be more than happy to walk you through some options to earn a bit more spread on similarly safe assets. Okay, next slide, please, Mr. Newell. So hopefully this has been helpful. What we did in lieu of doing a Q&A, I should have started with this, but the bulk of this content was derived from questions that we've been getting from clients and advisors over the past week. So hopefully we've hit north of 80, north of 90% of your questions and concerns. If you want to learn more, if you want to stay informed, please scan this QR code on your screen right now. This will take you to a page to register for our Making Sense of the Market quarterly webinar. myself and Matthew Eichmann and Eric Kraus, two of our advisors here and business leaders, we host a quarterly webinar where we kind of dig in more detail on the macro of the markets and kind of what we see on the horizon. So if you scan this code now, you can register for the April 11th discussion we're going to be having, where I'm sure we'll cover the banking sector in a bit more detail as well. So with that, I will thank my colleagues here, Clayton, Vineet, and Brett. Thank you for your insight and your analysis. And we will wish everybody a good afternoon and have a nice St. Patrick's Day tomorrow. And thank you very much.
Thank you.
Thanks, everyone.